While everyone is arguing about gold and silver, one metal just surged $78 in a single trading day. Palladium. As of mid-February 2026, it's sitting at around $1,678 per ounce. That's nearly double where it was trading at its 2024 lows, when you could pick it up for under $900. Russia produces about 40% of the world's supply. The European Union just delayed its combustion engine ban. Auto production is finally recovering after years of chip shortages. And here's the part that should bother you. Not a single major precious metals channel on YouTube is really covering this. Platinum got all the headlines in 2025. Silver broke 100. Gold hit new records. But palladium kept climbing, quietly and persistently, while nobody was looking. When you see why this rally is just getting started, you'll understand why the silence around this metal is the loudest signal of all. My name is Max, and this is Max Invests. I break down how money and markets actually work so you don't have to dig through the data yourself. We look at what's really there, not just the headlines. If you want to stay ahead of the market instead of chasing it, hit subscribe and like. It helps the channel more than you think. And stick around, because by the end, you'll see exactly why palladium sits at the intersection of supply concentration, geopolitical risk, and a demand catalyst that the market hasn't fully priced in yet. And there's a deeper reason this metal keeps getting ignored that has nothing to do with the fundamentals. I'll show you what it is before we're done. One quick question though, do you own any palladium? Or is this the first time you've seriously looked at it? Drop your answer in the comments because I'm genuinely curious how many of you have this metal on your radar. Now, if you've been following precious metals content on YouTube for any length of time, you've noticed something. It's gold, 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 silver, silver, silver. Maybe a platinum video every couple of weeks. That's it. That's the entire conversation. And look, I get it. Gold has the sound money narrative, silver has the retail stacking community. They have coins, bars, a culture built around them. You can walk into a coin shop and hold them in your hand. Palladium doesn't have any of that. There are no palladium stacking videos. There's no palladium community on Reddit arguing about premiums. It's an industrial metal that happens to be precious. And because it doesn't fit neatly into the gold and silver narrative, it gets left out of the conversation entirely. But here's the thing, the market does not care about your YouTube feed. The market does not care which metals have a fan club. The market cares about supply and demand. And right now, palladium's supply and demand picture is one of the most compelling stories in the entire commodity space. Think of it like this. Imagine you're watching a poker table. Everyone at the table is staring at two players, gold and silver, watching every move they make. But there's a third player at the end of the table who just quietly doubled their chip stack and nobody even glanced over. That's palladium right now. And the reason nobody's glancing over is about to become the reason everybody wishes they had. Because the supply side of this metal is a ticking time bomb. And I'm going to show you exactly why in a moment. But first, you need to understand just how concentrated this supply really is. What I'm about to show you next is the thing that separates palladium from almost every other metal on Earth. Pay close attention, because this is where the real story begins. Point number 1. The supply concentration is unlike anything else in precious metals. Here's what most people don't realize. 75% of the world's palladium comes from just two countries, Russia and South Africa. That's it. Russia, primarily through Nornickel, produces roughly 40% of global palladium supply. South Africa produces about 35%. Now think about what that means. You have one country under ongoing international sanctions with mounting operational challenges and declining ore grades. And you have another country that can't keep its power grid running. According to the World Platinum Investment Council's 2025 and 2026 data, South African mining operations continue to face the same rolling blackouts and energy instability that have been plaguing platinum production. Palladium comes from the same mines, same infrastructure problems, same bottlenecks. And here's what makes this even worse. If you wanted to open a new palladium mine today, you're looking at a 10 to 15-year development timeline before you see a single ounce of production. There is no quick fix for a palladium supply crunch. Recycling helps, but palladium recovered from spent catalytic converters operates on an 18 to 24-month lag from vehicle scrappage. So even that relief valve is delayed, which means the supply you have today is essentially the supply you're stuck with for the foreseeable future. And that supply is coming from two of the most geopolitically unstable sources on the planet. So much for supply. Now, the demand side. Point number 2. And this is where it gets really interesting. The demand side just got a massive shot in the arm that almost nobody is talking about. Palladium's primary use is in catalytic converters for gasoline engines, not diesel. That's platinum's territory. Gasoline. And what just happened in the European Union? They postponed the 2035 internal combustion engine ban. Let that settle in your mind for a moment. The single largest policy threat to palladium demand just got pushed back. Every year that combustion engines stay on the road is another year of catalytic converter production, another year of palladium consumption. But it's not just about the ban being delayed. Global auto production is finally recovering after years of semiconductor shortages that throttled output. Hybrid vehicles, which are the fastest growing segment in the auto market right now, still use catalytic converters. Every single one. And here's the kicker that nobody is factoring in. Tighter emission standards are coming, Euro 7 in Europe, China 7 in China. These regulations don't reduce the amount of palladium per vehicle. They increase it. More palladium per converter to meet stricter standards. So you have more cars being built, more hybrids on the road, a delayed phase out of combustion engines, and stricter emissions rules that require more palladium per vehicle. That's not one demand catalyst, that's 4 stacking on top of each other simultaneously. Point number 3. The price history tells you everything about where this is heading. In 2022, palladium hit roughly $3,000 an ounce. That was the panic premium when Russia invaded Ukraine, and the market suddenly realized that 40% of global supply was coming from a country at war. Then the narrative flipped. From 2022 through 2024, the story became all about substitution. Platinum was going to replace palladium in catalytic converters. Electric vehicles were going to eliminate catalytic converters entirely. Palladium was finished. The price cratered below $900 by 2024. A 70% collapse from the highs. And here's where the contrarian opportunity lives. That substitution narrative, it's running in reverse. According to recent data, palladium is now trading at around $1,678 per ounce, while platinum is at around $263. Read that again. Platinum is now more expensive than palladium in that comparison. Historically, that's unusual. For years, the argument was that automakers would switch from palladium to platinum because palladium was too expensive. But that logic falls apart when you look closer, because now palladium is the cheaper option. Some converter manufacturers are already beginning to rotate back toward palladium precisely because of this price differential. The substitution trade is reversing. The very narrative that crushed palladium's price is now becoming a tailwind. Point number 4. The broader platinum group metals rally confirms this isn't just palladium acting alone. On the same day, palladium jumped $78. Platinum rose 64 to around $263. Rhodium is holding steady around $10,300 per ounce. This is a sector-wide move in PGMs driven by real supply constraints and recovering industrial demand. When you see the entire group moving together, that tells you this isn't speculative noise. It's fundamental. It's structural. And structural moves don't reverse quickly, but why is almost nobody talking about it? That's the question I need to answer, because it reveals something important about how markets actually work versus how we think they work. The real reason palladium gets ignored has nothing to do with its fundamentals and everything to do with human psychology. We are drawn to narratives, not numbers. Gold has the narrative. It's the ultimate safe haven, the hedge against collapse, the ancient store of value. Silver has the narrative. It's the people's money, the affordable entry point, the industrial and monetary hybrid. These are stories. They're compelling. They're easy to tell. Palladium doesn't have a story like that. It's used in catalytic converters. It comes from Russia and South Africa. It's hard to buy physically. There's no palladium community, no palladium memes, no palladium stacking culture. And because of that, content creators don't cover it. Because content creators don't cover it, retail investors don't know about it. Because retail investors don't know about it, there's no audience for Palladium content. It's a self-reinforcing cycle of invisibility. But here's a hard truth that might sting a little. The metals that get the most attention are not always the metals that make the most money. In fact, the opposite is often true. The most crowded trades are the most picked over. The least crowded trades are where the inefficiencies live. And Palladium right now is the least crowded trade in precious metals. It's nearly doubled from its lows and nobody noticed. It jumped $78 in one day and it didn't trend. That's not a weakness, that's an edge. Because by the time something trends, by the time everyone is covering it, the move is largely over. You're buying at consensus, which means you're buying after the smart money already positioned. There's also an institutional angle worth understanding. Palladium ETFs exist, but they're thinly traded compared to gold and silver funds. The futures market is active, and mining stocks like Sibanye-Stillwater and Impala Platinum offer indirect exposure. But the thin trading itself is a signal. Low liquidity means that when institutional money does flow into this space, the price impact is amplified. A relatively small amount of capital can move Palladium's price significantly, which is exactly what you saw when it jumped nearly 5% in a single session. If this breakdown is helping you see the big picture, hit subscribe and turn on notifications so you don't miss the next time we connect the dots on money and markets. And drop a comment telling me what you want to see next. Palladium, gold, platinum, auto recovery, supply chain risks. The topics you ask about become the videos I make. Now let me tie this together. Because the individual pieces are interesting, but the system they create is what matters. You have a metal where 75% of global supply comes from two geopolitically unstable countries. One is under sanctions with declining ore grades. The other can't keep its lights on. New mine development takes 10 to 15 years. Recycling operates on a 2-year lag. That's the supply side. On the demand side, the EU just extended the life of combustion engines. Auto production is recovering, hybrid vehicle sales are surging. And tighter emission standards mean more palladium per vehicle, not less. The substitution narrative that crushed the price has reversed because platinum is now the more expensive option in that dynamic. And the entire PGM sector is rallying, confirming this is structural, not speculative. Remember that poker table I described earlier? The player nobody was watching just doubled their stack again. Palladium has gone from under 900 to 1678, and the table still hasn't looked over. The question you need to ask yourself isn't whether Palladium is a good investment. I'm not your financial advisor, and this isn't financial advice. The question is whether you're the kind of investor who only pays attention to what's trending, or the kind who pays attention to what's actually moving. Because in 2022, Palladium was at 3,000, and everyone was talking about it. By 2024, it was below 900, and everyone forgot about it. Now it's at 1678 and climbing, and the silence is deafening. Every single time the crowd shows up late, they buy the narrative after the price has already moved. They celebrate metals after the rally, not before. You're watching this video, which means you're seeing this before the crowd. What you do with that information, that's on you. Your future self, the one looking back at this moment from 12 or 18 months down the road, will either thank you for paying attention when nobody else was, or wonder why you scrolled past the one metal that was screaming opportunity while the rest of the market was distracted by shinier objects. Palladium, gold, platinum, the auto recovery, supply chain risks. Whatever is happening in these markets that you want me to dig deeper into, drop it in the comments. Tell me what you want to see next, because the topics you ask about become the videos I make. And if you want more videos like this, breaking down how money and markets actually connect, subscribe and hit the bell so you don't miss the next time we connect the dots before the headlines do. While you were watching gold break records and silver make headlines, Palladium quietly nearly doubled. No fanfare, no trending hashtags, no community rallying behind it. Just supply constraints, demand catalysts, and a price chart that doesn't care whether anyone is watching. That's the setup nobody sees coming. Now you see it. There's a specific feeling that hits you when you check your account balance and see $200,000 for the first time. Maybe you've been building toward it for 10 years. maybe it just clicked. It's not a celebration exactly, it's more like disbelief mixed with anxiety. Because on one hand, that's more money than you ever thought you'd have. But on the other hand, it still doesn't feel like enough. You run the numbers in your head and realize you're nowhere near retirement, nowhere near real security. You might have a spreadsheet, you might have a plan, but it still feels fragile. One market crash, one job loss, one emergency, and it could all feel at risk. And part of you wonders if you'll ever actually get there, or if this is just as far as hard work and saving can take you. The good news is the next phase doesn't require more sacrifice. It requires a different mindset. My name is Max, and this is Max Invests. I break down how money and markets actually work, so you don't have to dig through the data yourself. And I need to show you something about $200,000 that completely changes the game once you understand it. If you want more breakdowns like this, hit subscribe and turn on notifications. It helps more than you think. And drop a comment telling me where you're at. Are you close to 200,000 or already past it? I read everyone. Here's what most people believe. Getting to 200,000 is impressive, but it's still early in the wealth building journey. And the path from 200,000 to $1 million or more is basically the same grind that got you to 200,000 in the first place. Just keep saving, keep working, keep doing what you've been doing, and eventually you'll get there. That's the assumption. Just keep doing the same thing and scale up. But here's the truth that separates people who stay stuck at 200,000 from people who turn it into millions. 200,000 isn't the beginning of the journey. It's the inflection point. It's the moment when mathematics stops working against you and starts working for you. And if you don't recognize that shift and adjust your behavior accordingly, you'll waste the most powerful wealth-building years you'll ever have. You'll keep acting like someone at 50,000 when the math says you're playing a different game. Let me say that again. 200,000 is where everything changes, but only if you change with it. Think about what it took to get to 200,000. You probably spent a decade saving aggressively, living below your means, skipping the lifestyle upgrades your peers were indulging in. Every month felt like a grind because you were fighting against expenses, taxes, and the slow accumulation of small numbers. Getting from 0 to 50,000 took years. Getting from 50 to 100 took almost as long. The progress felt linear, not exponential. That first 50 felt like climbing a mountain. 50,000 to 100,000 took slightly less time, but still felt eternal. You started to see compound interest on the statement, but it was still mostly you. And 100,000 to 200,000, even with compound interest starting to show up, still required relentless discipline. So you internalize this idea that wealth building is linear, that it's always going to be this hard, that getting to $1 million means doing exactly what you did to get to 200,000 just 5 more times. But that's not how math works, not even close. Here's the invisible threshold you just crossed without realizing it. 200,000 is the point where your money starts earning more than you can realistically save from your salary. Let me show you what I mean. If you're making $80,000 a year and saving 20%, you're putting away $16,000 annually. That's solid. That's disciplined. But 200,000 invested at an average 8% return generates $16,000 a year without you doing anything. Your money is now working at the same pace you are. Same $16,000. One from your job, one from your portfolio. And that's the threshold. For the first time, the market is adding as much as you are. Before 200,000, you're the main engine. After it, the market starts to match you, then overtake you. That's the moment when compounding stops being theoretical and becomes the primary driver of your wealth. Most people hit this point and don't notice. They keep living the same way, saving the same percentage, thinking the same thoughts, and they miss the shift. That's why what comes next is so important. The rules of the game change, and most people keep playing by the old rules. Now here's the psychological transformation that has to happen at 200,000. You have to stop thinking like someone building from nothing and start thinking like someone managing a machine. Up until now, your wealth came from your labor. You worked, you earned, you saved, and that's how the account grew. But from 200,000 forward, your wealth comes primarily from what your money does, not what you do. And that requires a completely different mindset. You're not just a saver anymore. you're an allocator. Before 200,000, the main lever was how much you saved. After 200,000, the main lever is where that money sits and how long it stays invested. Your job is to put capital in the right place and then protect it. You're making decisions about where capital goes, how it's structured, and what it's optimized for. Tax efficiency, asset location, rebalancing. When you're at 20,000, 0.5% in fees might be $100. At 200,000, it's 1,000. At 2 million, it's 10,000. These start to matter. And those decisions matter more than how much you can squeeze out of your paycheck. Where you put that 200,000, how much you keep in stocks versus bonds. Whether you're in low-cost index funds or paying for expensive advice. All of that starts to matter more than working overtime. Let me give you the numbers that make this visceral. Pick an age, say you're 35 years old with 200,000 invested. You continue saving 16,000 a year from your salary. Same discipline you used to get here. If that 200,000 earns 8% annually and you keep adding 16,000 every year, here's what happens. Year 1, your portfolio grows to 232,000. 16,000 from your contributions, 16,000 from investment returns. Even split. You and the market are contributing the same amount for the first time. Year 5, you're at 314,000. You've put in 80,000 from your salary. The rest is the market. You've added 80,000 from your salary over those 5 years, but your portfolio grew by more than that. Still feels like slow progress. The first few years after 200,000 don't feel dramatic. Year 5, 10, 15, then you look up and see the curve. But watch what happens at year 10. You're at 458,000, and here's the key. Of that growth, only 160,000 came from your savings. The other chunk came from compound returns. Your money outweighed you. By year 15, you're at 821,000. You've put in 240,000 from your salary over 15 years. But your portfolio is worth more than 3 times that. By year 20, you're at 1.3 million. Over half of that growth came from compounding, not from you. And of that growth, over 700,000 came from compounding, not contributions. Your money did most of the work. You just had to let it. By year 25, you're past 1.6 million. By year 30, you're over 2 million. And the earlier you hit 200,000, the more dramatic these numbers get. Hit it at 30 instead of 35, and the end numbers are meaningfully higher. Time is still your biggest asset. Now here's where the identity shift happens. For years, you were the one pushing. Now the portfolio starts pushing with you. You stop being someone who's anxious about saving every dollar and become someone who's protective of the compounding process. You don't want to break what's finally working, because at this level, the biggest risk isn't that you won't save enough. It's that you'll interrupt the compounding. One big withdrawal, one panic sell, one chase into a hot stock or crypto. Any of that can set you back years, and the more you have, the more expensive that mistake becomes. You'll pull money out for a purchase that feels justified. You'll panic during a market drop and sell. You'll get impatient and chase some alternative investment that promises faster returns. And all of those decisions, every single one, breaks the compounding curve. And breaking the curve at 200,000 costs you exponentially more than breaking it at 50,000, because the numbers are bigger and the time frames are longer. Let me show you what I mean with a real scenario. You're at 200,000 and the market drops 25%. Now you're looking at 150,000. That feels terrible. You worked years to build that 50,000 and it disappeared in months. So you sell to stop the pain, you move everything to cash, and you wait for things to stabilize before getting back in. Except the market recovers faster than you expect. And by the time you're comfortable reinvesting, it's already back to where it was. You missed the rebound. You locked in the loss. And now instead of being at 200,000 on the path to compounding into millions, you're at 150,000 restarting the journey. That one emotional decision just cost you years of progress and potentially hundreds of thousands in future wealth. That's the danger at this level. The stakes are higher, the consequences compound. And this happens to people every single market cycle. They tell themselves they'll get back in when it's safe. But safe usually means after the rebound, when prices are high again. They don't think they're panic selling, they think they're being prudent. But they're locking in losses and resetting the clock. The market will test you. Corrections will happen. Your job is to not make it worse by reacting. Stay invested. Add when it's scary. That's when the best long-term returns get built. If this breakdown is helping you see the big picture, hit subscribe and turn on notifications so you don't miss the next time we connect the dots on money and markets. And drop a comment. I read them all. Here's where opportunities start looking completely different. Your relationship to money and to work shifts. When you're at $20,000, a job change that pays $10,000 more is transformational. It's a 50% raise. But when you're at $200,000 in investments, that same $10,000 raise is nice, but not life-changing. What's life-changing is a 5% better return on your portfolio. 5% of $200,000 is $10,000 a year. The same impact as the raise, except you didn't have to negotiate for it or change jobs. You just had to allocate smarter. That's the shift. At $20,000, your raise is everything. At $200,000, your allocation is everything. Your biggest financial leverage moves from career optimization to investment optimization. Where your money sits, what it costs you in fees, how you rebalance. That's where the leverage is now, and most people never make that mental transition. They keep focusing on salary increases while ignoring the fact that their portfolio decisions matter more. Now let me give you the big decision that most people at $200,000 get catastrophically wrong. They treat it as permission to upgrade their lifestyle. They've been disciplined for a decade. They've delayed gratification. They drove the same car. They skipped the big vacation. They said no to the bigger apartment. And now they finally feel like they have some breathing room. So they buy a nicer car, they move to a bigger house. They take the expensive vacation they've been putting off. And in their minds, they earned it. They deserve it. But here's what they don't calculate. Every dollar they pull out of compounding at $200,000 is a dollar that won't turn into $4 or $5 by the time they're 55, that $40,000 car they buy with cash. That's not a $40,000 decision. That's a $160,000 decision when you account for what it would have grown into over 20 years. That kitchen renovation, that dream vacation. Same idea. Most people never run that math. They see the number in their account and think they've arrived. They haven't. They've just reached the starting line where discipline matters most. Every dollar you pull out today is $4 or $5 you won't have at 55. The retirees sitting on 3 or 4 million didn't get there by rewarding themselves at 200,000. They didn't buy the upgrade car the year they hit the number. They didn't take the big trip or redo the house. They got there by recognizing that 200,000 wasn't the finish line. It was the starting gun. Here's the career power shift that happens when you hit 200,000 and protect it instead of spending it. You stop feeling desperate about your job. You know that if things go sideways, you have a cushion. Not enough to retire, but enough to make choices. Enough to take a few months finding the right next opportunity instead of grabbing the first offer. Enough to say no to a bad deal. Enough to negotiate harder because you're not operating from fear. You don't need this job to survive next month. That changes how you show up. And that shift in posture, that subtle confidence that comes from having options, shows up in every interaction. People sense it. You get better offers. You get more respect. You get opportunities you wouldn't have gotten when you were desperate. But here's the thing. That only works if the 200,000 is still there. If you spend it on lifestyle creep, you're right back to desperate. The power comes from having it and not needing to touch it. That's why the next mistake is so costly. Now let me give you the warning that destroys most people's trajectory at this level. They start comparing themselves to people who got rich faster. They see someone who made a killing in real estate or crypto or a startup, and suddenly their disciplined index fund strategy feels boring and slow. They forget that the people who got rich fast also got poor fast, or got lucky once and never repeated it. So they start taking risks. They put $50,000 into some investment they don't understand because they're chasing the quick win. And maybe it works, but usually it doesn't. And when it doesn't, they just cut their compounding base from $200,000 to $150,000. They set themselves back years trying to accelerate a process that was already working. The people who turned $200,000 into millions aren't the ones who got lucky with risky bets. They're the ones who stayed boring, who kept contributing, who didn't panic sell, who didn't chase shiny objects, who just let the math do what math does when you give it time and consistency. Boring works. Slow works. Consistency works. The people who blow up their portfolio chasing returns are the same people who could have had a calm, predictable path to 7 figures. Here's the thing about opportunity cost at $200,000 that most people never internalize. Every major purchase you make from this point forward isn't just costing you the nominal amount, it's costing you the compounded amount. If you spend $60,000 on a boat right now, you're not spending $60,000. You're spending the $300,000 that $60,000 would have turned into by retirement. And maybe the boat is worth that trade. Maybe the experiences and memories justify it. But you need to make that trade consciously, not impulsively, because most people make those decisions based on the sticker price without ever calculating the real cost. And the real cost is always way higher than they think. So before you make any big purchase from here on out, run the numbers. What would this amount become in 20 years at 7 or 8%? That's the real price tag, not the sticker. The real cost of saying yes to this and no to future you. So here's what I want you to take from this. $200,000 is the most important milestone in your wealth building journey. Not because it's a lot of money in absolute terms, but because it's the point where the mathematics flip, where your money starts out earning your labor, where compounding becomes the dominant force. And what you do in the 5 to 10 years after hitting $200,000 will determine whether you end up with a comfortable retirement or generational wealth. This is the window where small decisions have outsized consequences. Stay disciplined here and the rest gets easier. The path from $200,000 to $2 million isn't 5 times harder than the path from 0 to $200,000. It's easier because the engine is already running. Your money is already doing the heavy lifting. The numbers accelerate, the returns compound on top of returns. But only if you don't sabotage the process. Only if you keep contributing. Only if you stay invested through the volatility. Only if you resist the urge to celebrate with lifestyle inflation. Only if you don't pull money out for the car or the kitchen or the vacation. Only if you treat $200,000 as fuel for the next leg, not a reward to spend. Only if you recognize that $200,000 isn't the reward. It's the seed. Not the reward. The seed. What you do with it in the next decade decides whether you have a nice retirement or something that changes your family for generations. You have time right now to protect that seed and let it grow into something that changes your life. Not a lot of time, but enough. Enough to commit to not touching it for the next 15 years. Enough to keep adding to it even when it feels like the progress is slow. Enough to ignore the market noise and the comparison traps and the temptation to chase faster returns. Just stay the course. Keep contributing. Don't touch it. Let the math work and trust that the compounding you can't see yet is happening beneath the surface, building momentum that will eventually feel unstoppable. Most people never get there because they sabotage themselves right after $200,000. You don't have to be most people. The first few years after $200,000 might not feel that different. But year 5, year 10, year 15, that's when you'll look back and see the curve. And 20 years from now, when you're looking at a portfolio worth millions, when you realize that your money worked harder than you ever could have, when you understand that the decision to protect $200,000 instead of spending it was the decision that changed everything, you're going to remember this moment. The moment you learned that wealth isn't built by working harder. It's built by letting compounding run uninterrupted for as long as possible. And the moment you decided to give it that chance. If this video helped, subscribe and hit the bell so you don't miss the next breakdown. Drop a comment and tell me what you want to see next. Retirement math, allocation, or the next milestone. The topics you ask about become the videos I make. My name is Max. Thanks for watching. Warren Buffett just retired with $382 billion in cash. That's more than the Federal Reserve holds in Treasury bills. For 12 consecutive quarters, he's been a net seller of stocks. He sold 67% of Apple. He's still selling Bank of America. Meanwhile, his own Buffett indicator, the metric he once called the best single measure of where valuations stand, just hit its second highest reading in 155 years. The only time it was higher was right before the dot-com crash. But here's the part nobody's talking about. He's not just sitting on cash, He's earning $13.5 billion a year in risk-free interest while he waits. Waits for what? That's exactly what we need to talk about today, because when you see the pattern, and I mean the full historical pattern of what happens every single time Warren Buffett hoards cash at valuation extremes, you'll understand why his actions might be the most important signal in the market right now. I'm Max, and this is Max Invests. We break down how the smartest investors think and act. If this is your first time here, hit subscribe and drop a comment. Are you fully invested, or are you raising cash like Buffett? Let's get into it. Most people hear that Buffett is holding all this cash and they just shrug. He's 95. He just retired. Maybe he's winding down. Maybe he can't find deals at Berkshire scale anymore. Or maybe the Oracle has simply lost his touch. That dismissal is the trap. It lets you ignore the single most important capital allocator on the planet. It's exactly what people said back in 1999 when he refused to buy .com stocks. They said he was washed up, behind the times. Fortune magazine practically wrote his obituary as a relevant investor. Then the market crashed 50% over 2 years. And Buffett? He was buying assets for pennies with a pile of cash he'd been building for years. 1999 wasn't the first time. In 1968, he closed his entire investment partnership. He gave the money back to his investors. He said he couldn't find value anywhere. The market then crashed over 30% by 1974. Again, in 2005, he built a massive cash position years before the housing crisis. When the system melted down in 2008, he had cash to cut deals with Goldman Sachs and GE on terms so favorable they were practically highway robbery. So when Warren Buffett hoards cash at valuation extremes, it's not new behavior. It's a pattern. And every single time this pattern has appeared, a significant market event has followed. That's not a coincidence. That's history. And that's why what he's doing right now matters for every investor. So let's break down exactly what he's doing now. I'll walk you through 5 layers. Layer 1 is the cash pile. According to Berkshire's third quarter 2025 earnings, the company holds $381.7 billion in cash and treasury bills. That's up from $344 billion the prior quarter. The cash is still growing. Cash now represents 31% of Berkshire's total assets. That's the highest percentage in over 30 years. $320.5 billion of that is in short-term U.S. Treasury bills. That single number exceeds the Federal Reserve's own Treasury bill holdings, which are around $195 billion. A private company holds more T-bills than the central bank. Let that sink in. No one else in corporate America has ever sat on this much risk-free cash. That's not caution. That's conviction. Layer 2 is the selling spree. Berkshire has been a net seller of stocks for 12 consecutive quarters, 3 full years of selling more than buying. Total net sales since the first quarter of 2022 exceed $183 billion. That's the largest selling spree in the company's history. And get this, 0 share buybacks for 5 consecutive quarters. Buffett used to love buying back Berkshire stock. It was the easiest way to create value for shareholders. But with Berkshire's price to book above its 20-year average, he doesn't even see his own stock as a bargain. The man who built the company and knows its value better than anyone will not buy his own shares at these prices. And the reason goes deeper than most people realize. It's not just that the market is expensive, it's which names he's choosing to exit. Which brings us to layer 3, the Apple and Bank of America exits. Let's start with Apple. In January 2024, Berkshire held 95.6 million shares. That was about 50% of the equity portfolio. Then quarter by quarter, he sold. Over 116 million in the first quarter, 389 million in the second quarter, another 100 million in the third. When the dust settled, he had sold over 600 million shares. He reduced the position by 67%. Apple is still the largest holding, around $65 to $70 billion, about 21% of the portfolio. But the scale of that reduction is staggering. Why sell Apple? He's praised Tim Cook. He's called it one of the best businesses he's ever seen, because Apple's price to earnings climbed above 30. At his core, Buffett is a value investor. He doesn't care how great the company is if the price doesn't make mathematical sense. He's criticizing the price, not Apple. Now Bank of America. Buffett saved Buffett in 2011 with a $5 billion investment during the crisis. He made tens of billions in profit from it. Starting in July 2024, he began systematically reducing his stake. In the fourth quarter of 2024 alone, he sold 117.5 million shares. His ownership dropped from over 13% to 8.9%. The bank trades at 1.8 times tangible book value. That's well above its 10-year average of 1.5. Expensive by Buffett's standards. So he's selling. Same logic as Apple. Great business, wrong price. He's not emotional about it. He's just following the math. Layer 4 is where it gets really uncomfortable. The valuation nightmare. The Buffett indicator is total stock market cap divided by GDP. It just hit 220%. Some data from Guru Focus put it at a record 222.7% in January 2026. The historical average is around 80%. Before the dot-com peak in 2000, it was 140. Before the financial crisis in 2007, it was around 110. Now we're at 220 plus. It's not just above his overvalued threshold of 120, it's nearly double. Then there's the Shiller-Cape ratio. That's from Nobel laureate Robert Shiller at Yale. It compares S&P 500 prices to inflation-adjusted 10-year earnings. The historical mean is 17.3. Right now it's above 40. The only time it was higher was the dot-com bubble peak at 44.19. When CAPE is this elevated, Shiller's data implies about 1.7% annual return over the next 8 years or so, versus a historical average of over 10%. The math says stocks from these levels may return almost nothing for the better part of a decade. That doesn't mean a crash is guaranteed tomorrow. It means the odds of strong returns from here are historically low. Now, some of you might say this time is different. AI is real. These companies actually generate enormous cash flows. Apple, Alphabet, Microsoft. This isn't 1999 speculative mania. I get it. And those companies are nothing like the junk from 99. But valuation still matters. Even a great company can be a bad investment if you overpay. Think about Cisco in 2000. Phenomenal business. But if you bought at the peak, you waited over 20 years just to break even. Business quality doesn't protect you from overpaying. There's another risk: market concentration. The top 10 stocks dominate the index in a way we've rarely seen. If you're in a passive index fund, you think you're diversified, but you're actually making a massive concentrated bet on a handful of names. If those correct, the whole market corrects. So your index fund isn't as safe as you think. If you're finding this useful, hit subscribe and tell me in the comments. Are you raising BE or are you still bullish? I read everyone. Layer 5 is the tax angle. The current corporate tax rate is 21%. There's real discussion about rates potentially rising. Some proposals suggest 35%. If Buffett realizes capital gains now at 21% versus waiting and potentially paying 35% later, the math is enormous. On hundreds of billions in gains, tax savings could be tens of billions of dollars. So part of the selling spree isn't just valuation. It's locking in a lower tax rate while it still exists. On that scale, we're talking about tens of billions saved. That's not panic. That's chess. Here's the real magic. It's not any single data point. It's the psychology behind the behavior. Buffett doesn't need to predict a crash or time anything. He's built a position where he wins regardless. If markets keep rising, he earns 3.7 to 4.3% on treasury bills. Risk-free. That's $13.5 billion a year for doing nothing. If markets crash, he has $382 billion in dry powder to deploy. At current prices, that could theoretically acquire over 480 S&P 500 companies. Downside is modest. Upside is generational. He doesn't have to be right about when or how. He just has to be ready. I know this isn't what a lot of people want to hear. Everyone wants to believe everything's fine. The market will keep going up. But understanding this doesn't mean panic. It means think. Now, what does Buffett actually say in public? He says Berkshire will forever deploy the majority in equities. The cash pile shouldn't alarm investors. He simply can't find attractive opportunities at scale. Calm, reassuring words. But look at his actions. Selling stocks for 12 straight quarters. Hoarding record cash. 0 buybacks. Reducing even his favorite long-term holdings. Words say, stay calm. Actions say, I'm cashing out. And when the two conflict, the actions are what you should believe. His track record in 1968, 1999, and 2005 says, trust the actions. So what does this mean for you? You don't have Buffett's resources, but you can follow his logic. You don't have to copy him, just ask the same questions. First, review your exposure to overvalued sectors. Second, ask whether your portfolio is more concentrated than you realize. A lot of people think they're diversified with an index. They're not. Third, look at what T-bills and money market funds pay now. 4% plus risk-free is real money. That's not nothing when stocks might return almost nothing for years. Fourth, ask whether chasing returns at valuation extremes makes mathematical sense when Shiller Cape implies about 1.7% annual returns for the next 8 years. And fifth, you don't have to go to cash. But having dry powder and the ability to act when opportunities emerge isn't bearish. It's strategic. That's what Buffett has done at every major turning point. And all it's worth paying attention to. Buffett doesn't predict the storm. He builds the ark before the clouds appear. He didn't cash out to run away. He cashed out to reload. He's sitting on the largest war chest in corporate history, earning billions in interest every single year, waiting with the patience of someone who's done this 3 times before and been right every time. You don't need to predict what happens next. You need to be ready. The smartest investor who ever lived is telling you through every action that being ready matters more than being right. You don't have to sell everything, you just have to have a plan. Your future self, 5 to 10 years from now, is counting on you to pay attention. Not to panic, not to try to time the market, but to think clearly when everyone else is chasing momentum. Drop a comment below. What's your read on the market? Are you raising cash or are you still bullish? And if you have ideas for the next video, like Buffett's successor Greg Abel, or Treasury Dynamics, or AI valuation, put them in the comments. I read them all. Hit subscribe and turn on notifications for Max Invests. Thanks for watching. See you in the next one.